Imagine going to an American supermarket with a list of ordinary things. Milk, eggs, bread, chicken, fruit, vegetables. Nothing luxurious. You reach the checkout, the cashier tells you the total, and you pull out your credit card. For millions of Americans, that isn't unusual. But there's an important difference between using a credit card to pay for groceries and using credit because you don't have enough cash to pay for them. A new 2026 study from the Urban Institute gives us a disturbing look at that difference. Among working-age Americans surveyed, 34.9% used a credit card for groceries and paid the balance in full. But 19.6% paid less than the full balance, while 8.7% didn't always make the minimum payment. That means more than 1 in 4 working-age adults who used credit cards for groceries experienced a repayment challenge. So what's happening? Are Americans simply spending too much? Or has something changed in the economics of buying the most basic thing imaginable? Food? The grocery bill changed. To understand the credit card problem, we first need to understand the grocery bill. And there's one economic concept that often gets misunderstood. Lower inflation does not mean lower prices. If the price of a product rises 10% one year and then rises only 2% the following year, inflation has slowed. But the price is still much higher than it was before. That's essentially what American households have been experiencing with food. According to the USDA Economic Research Service, food at home prices, the category that covers food purchased from grocery stores and supermarkets, were 2.7% higher in June 2026 than a year earlier. Overall food prices were up 3%. And some categories are moving much faster. In June 2026, beef and veal prices were 11.8% higher than a year earlier. The USDA says the U.S. cattle herd has fallen to its lowest level in 75 years, while wholesale beef prices remain historically high for this time of year. So when someone says, "But inflation is coming down," that's only part of the story. The grocery receipt doesn't show the inflation rate. It shows the price level. And that distinction matters enormously for families operating on tight budgets. 2. The price SHCK didn't disappear. USDA data show that average food-at-home prices increased 2.3% in 2025 compared with 2024. That was actually below the historical 20-year average of 2.6%. But some categories behaved very differently. In 2025, egg prices averaged 21.9% higher than in 2024. Beef and veal increased 11.6%. Sugar and sweets increased 5.1%. Non-alcoholic beverages increased 3.8%. Meanwhile, some categories actually became cheaper. Fresh vegetables declined 0.4%. Fats and oils declined 0.8%. This is why saying food prices are rising is technically too simple. Some prices rise, some fall. Some remain elevated after previous increases. And consumers don't buy the average basket published in an economic report. They buy their own basket. A family buying a lot of beef feels the market differently from a family buying mostly rice, beans, and vegetables. A parent buying infant formula has a completely different grocery budget from a single adult. The national average hides those differences. 3. The $200 problem. Now imagine a household that normally has just enough money to cover its monthly expenses. Their income hasn't collapsed. They still have a job. But their budget has very little room. Then groceries cost another $50. Then gasoline costs more. Then the electricity bill arrives. Then the car needs a repair. Nothing individually looks catastrophic. But together they create a problem. The household now has 2 choices: cut something, or move part of the expense into the future. That's where credit enters the picture. And a credit card is particularly convenient because it doesn't require the consumer to negotiate a new loan every time they go shopping. The card is already in their wallet. The supermarket accepts it. The transaction takes seconds. The food goes home. The payment comes later. That convenience is precisely why credit can become a financial bridge. But a bridge doesn't make the underlying gap disappear. 4. What the 2026 data actually show. The Urban Institute's latest analysis is especially useful because it doesn't simply ask whether Americans own credit cards. It asks how families actually used financial resources to buy groceries. The research comes from the December 2025 Well-Being and Basic Needs Survey, with more than 10,000 adults participating, including more than 7,500 adults between 18 and 64. Among working-age adults, 34.9% used credit cards for groceries and paid the bill in full. 19.6% used credit cards but paid less than the full balance while always making at least the minimum payment. 8.7% didn't always make the minimum payment. Those last two categories are crucial, because they indicate that the grocery purchase wasn't simply being charged for convenience. The household was carrying some degree of financial pressure forward. And this isn't an isolated phenomenon involving credit cards. Nearly 1 in 5 working-age adults, 19.6%, reported using savings that weren't intended for daily expenses to pay for groceries. Nearly 1 in 10 used buy now, pay later for groceries. And 5.2% used cash from a recent payday loan to buy groceries. These methods aren't mutually exclusive. A household could be using more than one. And that tells us something important. When food becomes difficult to fit into a budget, families don't all respond in the same way. Some use savings. Some use credit. Some use installment products. Some borrow at very high cost. 5. Who is actually using credit? Here's where the story becomes much more interesting. The problem isn't distributed evenly across America. According to the Urban Institute, more than half of low and moderate-income working-age adults who used credit cards for groceries did not pay the full balance. Among higher-income adults, it was just over 1/3. That difference is logical. If your monthly budget has $2,000 of disposable room after essential expenses, a $100 unexpected grocery increase is inconvenient. If your budget has only $100 of room, the same increase can force a financial decision. This is why income isn't simply about how much someone earns. It's about how much flexibility remains after essential expenses. Two households can earn very different amounts but experience the same financial stress if their fixed costs consume most of their income. And food is particularly difficult because you can't simply eliminate it. You can postpone buying a new television. You can cancel a vacation. You can delay upgrading your phone. But eventually, somebody has to buy dinner. 6. The most important number in the study. There's another statistic in the Urban Institute research that deserves attention. 51.3% of working-age adults said their grocery costs had increased a lot during the previous 12 months. Among people reporting that large increase, 12.4% did not always make the minimum payment when using credit cards for groceries. Among those who reported that grocery costs had increased only a little, the figure was 5.2%. For those reporting no increase, it was 4.8%. That's a substantial difference. But we need to be careful here. This doesn't prove that higher grocery prices directly caused every missed credit card payment. People's financial situations are complicated. Income, housing costs, employment, existing debt, medical expenses, and many other factors can affect repayment. What the survey does show is a strong relationship between perceived increases in grocery costs and repayment difficulties. And that's exactly the kind of distinction good financial reporting needs to make. Correlation is not automatically causation. 7. Credit isn't always the villain. There's another side to this story. Using a credit card isn't inherently bad. If someone spends $150 on groceries, puts it on a rewards card, and pays the entire statement balance on time, they haven't necessarily created a debt problem. They've simply used a payment method. Credit can also help households smooth expenses when income and expenses don't arrive at exactly the same time. The problem begins when the balance becomes revolving debt. At that point, the grocery purchase can continue costing money long after the food has been eaten. And this creates a strange financial situation. The original purchase may have been completely ordinary, a week's groceries, but the debt can survive into the next month. And the next grocery bill arrives again. So the household may be paying for last month's groceries while financing this month's groceries. That is where the cycle can become difficult to escape. 8. America's credit card debt. Now zoom out. The grocery aisle is only one part of a much larger consumer credit system. The Federal Reserve Bank of New York's household debt data show that U.S. household debt reached approximately $18.8 trillion in the second quarter of 2026. Credit card balances were around $1.26 trillion. That figure represents total outstanding credit card balances, not grocery spending. That's an important distinction. We cannot say, Americans have $1.26 trillion of grocery debt. The data don't say that. But we can say that grocery borrowing is occurring within an environment where credit card balances are already extraordinarily large. And when households begin using revolving credit for necessities, their financial flexibility can become increasingly limited. 9. The real cost isn't just the grocery bill. Think about the difference between these two purchases. You buy $200 worth of groceries. If you pay the card in full, the financial transaction ends. But if you carry the balance, the transaction doesn't really end at checkout. The debt continues. Interest can accumulate. Your available credit can shrink. Your next bill arrives. And now another month's expenses have to fit around the previous balance. This is why borrowing for necessities can be particularly dangerous. It's not because groceries are somehow a bad purchase. It's because the household cannot postpone the next grocery bill. A person can stop borrowing for a luxury. They cannot simply stop eating. So if the underlying income-expense gap remains, the household can be forced to repeatedly use the same financial tool. 10. The savings problem. Credit isn't the only thing being depleted. Savings matter too. The Urban Institute found that 19.6% of working-age adults use savings not intended for daily expenses to pay for groceries in 2025. That can solve the immediate problem. But emergency savings exist for another reason. A job loss, a medical bill, a broken car, a major home repair. When money intended for future emergencies is repeatedly used for today's groceries, the household becomes more vulnerable to the next unexpected expense. And that can create a second cycle. High grocery costs, savings depletion, unexpected emergency, new borrowing. The grocery bill may be the first visible problem, but the financial consequences can extend much further. 11. What happens next? The USDA's current outlook doesn't suggest grocery prices are about to return to their old levels. Its July 2026 forecast projects food at home prices to rise another 2.7% during 2026, slightly above the 20-year historical average of 2.6%. That doesn't mean every grocery item will rise 2.7%. The USDA expects significant variation between categories. But it does mean households shouldn't assume that slower inflation automatically brings a return to the prices they remember from years ago. And that leaves American families facing a fundamental question. Can income keep up with the cost of maintaining a normal life? 12. The bigger story. So why are Americans using credit cards to buy groceries? The answer isn't simply, because Americans are bad with money. The data are more complicated. Some people use credit cards strategically and pay them off every month. Others are carrying balances because their budgets don't have enough room. Some are using savings. Others are turning to BNPL or payday loans. And the households under the most pressure are disproportionately those with lower and moderate incomes. The grocery store is therefore becoming something more than a place where Americans buy food. It's becoming a place where we can see the collision between prices, income, savings, and debt. And perhaps the most revealing part is this. When someone uses a credit card to buy a luxury, they're borrowing to buy something they want. When someone uses it to buy groceries, they're often borrowing to maintain something they need. And that's why the grocery receipt may be telling us something much bigger about the American economy. The problem isn't that Americans have discovered credit cards. The problem is that for some households, the distance between what they earn and what everyday life costs has become large enough that credit is being used to cross the gap. And until that gap closes, the checkout counter may remain one of the clearest places to see America's financial pressure.